This is the Pinnacle Manufacturing Assessment by Isaac Bracken, Joshua Daubenbarger, Jordan Roy, and Joanna Cranover. Okay, so to start off, we're going to go just through the year-to-year percent change. The accounts we chose were net sales, gross profit, income before tax, current assets, and current liabilities. I'm just going to point out a few big percentage changes. So from 2014 to 2015, income before tax decreased 37.98%. Current assets from 2015 to 2016 increased from 27.74%. And then current liabilities, 2015 to 2016, increased 41.28%.
I'm going to be going over the common ratios. We chose current ratio, debt to equity, return on asset, gross profit margin, and profit margin ratios. These ratios help give investors a more in-depth look into the company and the financial health of said company. The current ratio measures how liquid a company is and able to pay off the short-term debt. Although we see a positive current ratio over 1, there is still caution to be raised. Over the 3 years that are being looked at, we can see that the current ratio has decreased steadily every year. This is showing a decreased ability to pay off the short-term debts of Pinnacle. The debt to equity ratio is an indicator of the percentage of company financing that comes from creditors and investors. The higher the ratio, the more credit financing the company is using. Over the 3 years that are being looked at, we can see an increase in credit financing, especially in 2016. Return on asset refers to how effectively a company can earn a return on its investment in assets. It simply tells us how effective it can turn assets into net income or profits. Again, there is a decrease, and that is something to be cautious of. Gross profit margin tells us and is an indicator of the financial health of a company. From the data given, we can see that the gross profit margin is slowly decreasing, which raises some eyebrows. The profit margin is profit divided by its revenue. Although there has not been a huge decrease, it is something that could become an issue in the future. The company is not as profitable as it has been in the past and could be an issue to the going concern. The sum of all this data is showing us to be cautious of Pinnacle's future. The company is currently in decline as does not show great signs of increase. This is problematic in an aspect of its going concern.
For the common size income statements for all of the divisions, some areas of concern are the depreciation expense, the legal service fees, total operating expense, and the income before taxes. Depreciation expense increased by 0.52%. Legal service fee doubled from 2014 to 2016. Total operating expense decreased from 19.13% to 17.94%, and income before taxes also decreased by 0.72%.
So now we have the common size income statement for one of the divisions, Welborn. The accounts we chose were property taxes, security, depreciation expense, and payroll benefits. So property taxes went down from 0.12% in 2015, 0.01% in 2016, which is almost nothing. Security went down from 0.43% in 2015 to 0.36% in 2016, which is alarming just because it was so consistent in 2014, 2015, and then all of a sudden it dropped. Depreciation expense went from 3.11% in 2015 to 3.43% in 2016, which is over $500,000. Payroll benefits went down from 1.97 in 2015 to 1.66 in 2016, which means they're either cutting employees or cutting down the benefits, which could raise an eyebrow. Then for solar electro, we chose property taxes, legal service, salaries and sales, and miscellaneous. The property taxes ended up being the same as Welborn. Legal service jumped up from 0.21 in 2015 to 1.19 in 2016, which could be problematic because that means they're having more legal encounters, which is never a good thing. Salaries and sales went down from 11.08 in 2015 to 9.7 in 2016, which then leads back to cutting employees or cutting the amount we're paying them. And then we have miscellaneous jumping from 0.2 in 2015 to 1.04 in 2016, which is it's kind of problematic because a $200,000 jump in the miscellaneous account could be due to fraud or just bad reporting.
Accounts with concern for material misstatement for the machine tech division are bad debts, depreciation expense, payroll benefits, and operating income. Bad debts decreased by 0.28%, depreciation expense increased by around 1%, payroll benefits increased by about 0.5%, and operating income increased by 4.11%.
Using the divisional income statements, we believe can give the best indicator for the potential of material misstatement. The divisional income statements help bring a more in-depth look into the financials of the company. There has been an increase in spending of the divisional income statements that should be raising eyebrows and could be affecting Pinnacle in a material way. The increased spending is coming from accounts that have a fairly general use and should be a red flag and should be audited. Within the next 12 months, we believe Pinnacle Manufacturing is at a medium risk of failure for its going concern.
So part 2 is assessing the acceptable audit risk for the client, which is Pinnacle. There were 3 main things that we're looking at, which is the external users' reliance on financial statements, as well as the likelihood of financial difficulties and management integrity. There are 11 situations that were given to us. However, I'm going to only be going over a few of them that I thought were very pertinent. One of them was going to be an article that was posted about Pinnacle's switch to renewable energy from diesel. This is specifically related to the solar electro division. It said, based on the regulations that are currently in place, it was unlikely that they would be able to make a profit until about 10 years in the future, which then gives likelihood of financial difficulties. Another one was that there was unknown engines sitting in the warehousing inventory that were not advertised as something that could be sold, nor did the warehousing manager, who had been working there for a year, know when they were manufactured. Thus, these were probably on the accounts and should have been obsolete, which then leads to external users' reliance on financial statements, since inventory could be misrepresented. Another one that was done was the use of significant amount of debt to finance construction. This was again related to the solar electro division. The board of directors wanted to use more debt in order to get more investment and build constructions and warehousing and plants for the division. However, the debt to equity ratio is already reaching an unacceptable level for the company as a whole. So thus doing this would increase it to past the 1% that they had set. So another situation that I thought was very pertinent was the fact that there was a high turnover rate within the internal audit team. Upon looking further into this, it was found that it was exclusively from the upper management. This is an indicator of potential management integrity not being intact, especially since there could be a breakdown between the actual company and the internal audit team. And then a final one was the dispute between the IRS and Pinnacle. This is a very clear potential misrepresentation of any after-tax income that was shown. So external users of financial statements would probably have been would have been materially misrepresented, and they would be using incorrect information to make business decisions. All right, so finally I have deemed that this client is low for acceptable audit risk. Again, this is mainly because of the 3 points of the debt to equity ratio increasing to an unacceptable level for the whole company. There's a high turnover rate within the internal audit team, as well as an IRS dispute, all of which are related to the 3 main points that were brought up earlier. This is a table that looks at the inherent audit risk within the situations that were given. There's 4 up here, but I'm mainly going to be focusing on 2 of them. First is a related party transaction. This is mainly going to be coming from the fact that there was a loan given to Solar Electro from Wellburn. Though it's still the same under the same company of Pinnacle, this is going to be increasing again their debt to equity. The relative audit objectives are going to be accuracy to see if these are correctly recorded in proper amounts. Finally, we have judgment related to currently recorded account balance and transactions. This is again going to be focusing on the inventory that was being held in the warehouse. So the accounts again are going to be inventory and cost of goods sold. And here we have accuracy, completeness, realizable value, and rights and obligations as the relevant audit objectives.